What's up, everybody? It's Joey Rockenstein. Thanks for tuning in for part two of my series, Understanding Mortgage Terms, Mortgage 101. That's right, we're going to go in depth on learning those confusing terms like DTI, LTV, TMI. Do me a favor, subscribe to my channel, give me a thumbs up in life and on my channel. I'd appreciate both. Thank you.
What is for example, like a escrow? What does the escrow mean?
Escrow is a neutral third party between all parties involved in the transaction, and they're the ones who handle the money, pretty much. Like when we fund a loan for a client, we send the wire to escrow and the title company. They work hand in hand together, and then they go ahead and make sure that everybody's accountable, and they get a copy of the contract and make sure that the sales price is implemented, that if there are any credits, or let's say after you do your home inspection, you say, oh, you know what, that needs this and this fixed, and the seller agrees to give you some money for those credits, they're responsible for adding that addendum, or rather enforcing that addendum, and just keeping everybody honest is what I like to say escrow does.
That's good to know, because some people think that I'm going to be the one holding the money, and I, as a realtor, am not going to be holding any money at all. So the escrow handles the money.
Escrow handles the money. Neutral third party.
Exactly. Keyword, neutral.
Neutral. In some states, there's closing attorneys, depending on what state you're in. It's an actual attorney that handles all of it. So it depends on what state you're in.
Absolutely. Great. Any more pertinent terms that you think people should be aware of? Oh
yeah, I got lots more. Let's
Good.
Let me try and keep them short and cute here for you guys, though. But it's stuff you need to know. I touched on points a little bit earlier, and everybody should definitely understand what that means. A point is equal to 1% of your loan amount. Okay, so when you're getting different rate quotes, this is why I always say too, you really got to pick the right mortgage professional, because people can try and pull a fast one on you, and you want to make sure that you understand, even though obviously ethically they absolutely should not do that, but to get your application in the door, they might, there's bad apples in every bunch. I'll leave it at that.
Yeah.
You want to ask, is that rate that you're quoting me, is it include points, no points? Another word for it is a buy down or an origination fee. They might say, oh, it's no points, but then they want to just toss in a big origination fee. So they all kind of mean the same thing. You want to understand what is the whole cost associated with that interest rate. So, for example, a lender can really give you a rate three different ways. The most common way is for them to quote you a par rate, and that's generally what I quote my clients. That means you don't pay us any discount points for the rate that I'm quoting you, but I also don't credit you back any money with that interest rate towards your closing costs. So let's use 3% for the sake of an example here. Let's say that's my par rate, okay? Break even. Well, if someone says, no, I really want 2.75, I can say, okay, based on the market today and the way, my rate sheet looks, the pricing today says that for 2.75, that's going to cost you 1 point. Because you're basically buying down that rate with the bank and saying, I'm going to give you this money up front to get that lower rate, but then, you are saving interest over the course of the loan. You really have to consider your long-term plan for the property when deciding whether to pay points or not. If you're going to stay a long time, I think sometimes it makes sense to buy it down if you have the cash to do that. And you say, hey, I'm going to keep this house, for the full term of the loan, 30 years. Yeah, I want the lowest rate possible because the interest I'm going to save over time makes sense for that. Maybe $5,000 that I'm going to pay, let's say on a $500,000 loan amount, 1.5,000 to get that quarter of a point less. It makes sense. They say, no, you know what, Natalia, I'm going to be out of this house in 2 or 3 years. I just want as little cash out of pocket as possible. I can say, okay, you know what? maybe I'll give you a rate of 3.25, and based on the pricing today, I can give you 1 point as a credit towards your closing costs. So now we're paying them to take a little higher rate.
Interesting.
And giving them a credit.
Right.
It's called the lender credit. So there's a few different ways you can work it. And like I always say, you just got to know your plan for the property when trying to make that determination. One thing I will say right now is everyone says, before people said, well, maybe I'll refinance out of the loan so it doesn't make sense to pay it. But with historically low rates, I wouldn't count on refinancing. If you think you're going to keep the property, if it makes sense, buy it down a little bit and save on that monthly payment and the interest over the course of the loan. Because once you really look at what you pay over the full 30 years, it could make a big difference for that little bit of money up front to get the best rate.
See, this is why it's so important to talk to a lender to understand these things. Like, people wouldn't understand about being able to buy down, to get the rate that they want, or, to have that percentage go towards closing costs. So this is great information that people need to know and understand.
Totally, yeah. Lots of different ways to manipulate all of that to suit, your needs. So it's really important that you're working with someone honest and, gives you these options up front. Super important.
That's great.
I think, Joey, if you're okay with the next thing that we should touch on when you go to apply for a loan and that a lender's going to take a close look at is what's called a debt to income ratio, or DTI, because everyone says, well, what do I qualify for? Or all my agents and realtors that I work with, well, what do they qualify for?
Right.
And it's not just about, oh, I feel like I can afford this monthly payment, so that's what I'm going to take. No, a lender does not go, okay, you have great credit, but we're not going to look at your income and see what you qualify for and all that. That's what brought down the market before.
Yeah.
So there's a lot of strict federal regulation. It's called the ability to repay rule surrounding this topic. And we are held to a very high standard as it pertains to debt to income ratio. So what that means is pretty much exactly what it stands for, debt to income. So let's say you have a car payment on your credit report. We're going to look at that monthly payment. Then let's say you have a credit card, or maybe you have 5 credit cards. We're going to look at those minimum monthly payments. It's not necessarily how much overall debt you're in. We're looking at the monthly payments, your ability to pay and repay on a monthly basis. Let's say you have a student loan in there. We're going to take the total of all those monthly payments and divide them by whatever we determine your gross monthly income is. And it's whatever that percentage is a guideline that we use. So for example, there's what's called the front end debt to income ratio and the back end debt to income ratio. The front end is just the monthly payments, not including your new proposed mortgage payment.
Okay.
The back end debt to income ratio, which is the most important one, is your monthly payments plus whatever the proposed new payment is, plus tax, plus insurance, plus HOA fees, and any other applicable hard, monthly expenses associated with obtaining this loan and this property, and then divided against your gross monthly income. So, for example, generally on conforming loans, and it will vary a little bit lender by lender, but let's say we're talking about like a Fannie Mae conventional mortgage.
Okay.
Generally, if it's an owner-occupied property nationwide, the standard is that you can't exceed about a 50% back-end debt-to-income ratio. As you get into jumbo territory, most lenders will cap you out at about 43% on that debt-to-income ratio if you're doing an actual qualified mortgage. So that's what determines what you can afford in addition to the down payment. It's the two combined, that's what's going to move the needle the most for you in what you buy.
And that is so important to know too, because most people, seems like the majority of the people I work with think that just because maybe they have a good job, then they're going to qualify for a certain amount or be able to afford this house, when there's so many other factors that are in play that they need to understand as far as like, you know, what they're spending each month versus how much they're actually taking in.
Yeah, it's actually considered predatory lending if, you know, lenders try to make loans and not take that into account, you know, so you have to kind of qualify. I mean, I know there's, you know, some portfolio products out there and people would argue like, oh, well, I qualified off of, you know, bank statements, and like there are more creative ways to qualify and arrive at that number, but you have to show some sort of income, even if it's not like tax returns or pay stubs. So everybody's held to that standard unless you're doing like hard money and business lending, and that's a whole different conversation.
Interesting. Well, what do you think?
I think we should maybe touch on a last term here that I get a lot, and that is LTV.
So important.
Loan to value. And that, once again, is a function of your down payment, but it's a guideline that every lender has, and depending on who you're working with, they're going to have different caps on that loan to value ratio. So for example, you buy a $100,000 property, you put 20% down, you have an $80,000 loan, you're at an 80% loan to value ratio. So people forget about that, but it's a very common term when you go to apply for a loan.
Interesting. Good to know. Yeah. Man, my mind is blown. Like there's so many terms that just get thrown out that just go right over, you know, buyer's head. So this is great information for them to have.
Yeah. These are some of the key factors that you should understand when trying to qualify and understand what you qualify for. Obviously, there's a million other things that go into a loan and little caveats, which I won't, you know, that's my job to worry about. But these are some of the key things that I think people should know as a consumer. Absolutely.
And I tell you what, guys, I will put Natalia's contact information in the description below. You can contact and reach out to her if you have any questions about starting the home buying process or just questions about loans in general. She is the one to help you out with that.
Yeah. Love to help. If you are in California, anywhere in California, I'm licensed in California, and I'd be happy to talk with you. Prosperity Home Mortgage, though, is a national company. So even if I can't help you, and you're in another state, definitely still reach out and I will get you a referral. We have some of the best mortgage consultants actually in the business. Really high integrity, great organization here. So happy to make those referrals for you guys.
Oh, that's so great. Thank you so much. And thanks for being on the show.
Thanks for having me. Pleasure as always.
All right. Thanks, guys. I'm Joey Rockenstein, Rockin' Real Estate LA, results that rock. See ya.